Good morning, everyone. Well, that is the sound of silence. What's happening? Did we not have breakfast? Or did we have too much fun at the gala dinner yesterday? Good morning, everyone. That's more like it. There you go. Thank you very much for coming in for the first session of the day. We'll be talking about the challenges around blended finance. How do we raise it? How do we structure it? How do we deploy it? There's a $100 billion funding gap as far as infrastructure is concerned, up and down across Africa, from the west to the north, the east and the south. We need as much capital as we can find. But where do we find it? At what cost? And how do we deploy it? We'll be exploring those issues in detail with my panelists in just a moment. But to set the stage for us, let me bring up to the stage Denis Medvedev from IFC. Denis, the stage is yours.
Good morning, everyone. Let's make sure that the slides are working. So, while the slides are coming up, my name is Denis Medvedev. I am here representing the IFC. I lead the Economic Policy Research Department over there, and as part of the work that we do in the Economic Policy Research Department, I also work very closely with my colleagues who work on blended finance. So I'll share a few thoughts with you around how the overall blended finance architecture, which will hopefully set the stage for the more interesting part of the panel, which will come later. So what is blended finance? Let's start with the basics. So when we talk about blended finance, we talk about a package that brings together concessional finance that is provided by development partners together with commercial funding that is provided by DFIs, including IFC, and other co-investors. Since about 2010, so in the last 12 years or so, IFC altogether has leveraged around $17.2 billion of blended finance. As you can see on this slide, it basically comes together from a chunk of third-party capital. That's the 7.7 billion, the 9.5 billion of IFC's own resources, and the 3.1 is actually the concessional element. So all of these come together to form the overall blended finance package. So that the bottom box of 3.1 should actually be the concessional part. Now, there are a couple of things there that are really important. We'll talk a little bit more about this, but the idea is that blended finance is an instrument to support high-income projects that would not otherwise receive funding on strictly commercial terms. For us at the IFC, really the big step change in terms of the availability of blended finance has been what is called the private sector window of IDA, the International Development Association. This is the overall big pot of money that's channeled through the World Bank Group towards the lowest income countries. And in 2017, let's sort of put aside the fiscal years, the big decision was to make those funds also available not only for lending to government, but also to be used as part of the blended finance package to go towards the private sector. As a result of that, we've actually been able to scale up dramatically our blended finance commitments, going from something like an average of about $100 million a year between 2012 and 2017 to around $500 million a year in 2018 to 2022. So this was the big innovation, at least when it comes to IFC's ability to leverage blended finance. And this really allowed us to go into low-income settings, fragile settings, look at areas in health, in agriculture, gender, SME, and climate that, again, otherwise would not necessarily be able to attract financing on purely commercial terms. So what are some of the principles behind the use of blended finance? Here we have really kind of 5 sets which come together. The first is the rationale, the economic case. This is really the idea that there has to be additionality when you use blended finance, right? Blended finance is not an instrument to just bring down the cost of funding. Otherwise, it could be used everywhere. The point is, how do we use it strategically, particularly in today's setting where the needs are growing and at the same time the availability of financing may actually be diminished. So these core principles really can guide us where blended finance is most appropriate. So the first, again, is the economic case, the additionality. Is this something that would not have happened without the use of blended finance? The second part is the crowding in and the minimum concessionality. What is kind of the minimum level of subsidy? What is the minimum contribution that's needed to make the project viable? Let's use those scarce resources carefully and channel them just enough to get that project over the line. The third principle is commercial sustainability. This is the long-term goal. The use of blended finance, and I'll talk a little bit more about this in the next slide, isn't there to provide permanent long-term subsidy. It's to guide projects towards commercial sustainability. It's basically make the case that things work, de-risk things in the short term, but really set up a sustainable path for commercial funding down the road, which is this fourth principle, the idea that once you address the market failure, the market itself can function. Once you remove the information bottlenecks, once you remove uncertainties, once you kind of realign incentives, things can work a bit more efficiently on their own and may not need a subsidy or such a level of subsidy. And of course, around that there has to be standards. There have to be standards around transparency, corporate governance, environmental impact, and disclosure. And IFC has been making a big effort, particularly around the disclosure side. So all of the information around the use of blended finance, the leverage is available there on our website when we talk about our blended finance transactions. So I talked a little bit about this continuum already, but if we think about kind of purely public sector interventions, things that governments spend money on, and purely private interventions, right? Something that can be funded by a commercial entity, there's a scale there. And traditionally, DFIs, including the IFC, operate here in spectrum number 4. So actually, by our article of association, we are required to make commercial investments and make profits on our investments. But we realize that, again, with the type of challenges that the world faces, where we are needed the most, where private funding is needed the most, isn't always feasible to enter on purely commercial terms. So this is where This is where this box 3 comes in, the not fully commercial, the temporary subsidy, this idea that you bring in blended finance to address specific challenges and later on enable the entry of more sustainable, fully private finance. It's not a silver bullet, right? And it has to be used in tandem with other types of instruments, such as policy reforms, such as capacity building, such as preparing markets, what we at the IFC call upstream types of interventions. So, all right, there we go. So there are a number of specific instruments that are used to implement blended finance, including risk mitigation, guarantees, types of concessional debt, different types of equity, performance-based incentive, and local currency lending. And essentially what they're trying to do is operate along the different dimensions of pricing. So how do we get the pricing right? How do we make sure that funding is provided at the cost that will be able to have the project move along? How do we mitigate risk in a way that, again, makes this project viable? How do we structure that particular deal? And especially thinking about local currency instruments. This is where it's important to recall that the majority of blended finance instruments, including the majority of instruments that IFC uses, including even the IDA private sector window that I had mentioned earlier, those are returnable capital. Those are instruments that bring the return on capital back to the original contributors of that capital. However, in some cases, there are also opportunities to use capital depleting type instruments such as performance-based incentives and other things which actually can bring the risk down even lower, but of course, again, require, on the other hand, a greater level of comfort by the donors, by people who are bringing this concessional finance into the equation to, again, have instruments that potentially may use up the capital that has been put in. So the idea is to balance the transaction around three dimensions, around risk, and thinking about how do we bring the risk down, whether it's country, sector, at the level of the project, how do we align those kinds of elements, and there are de-risking instruments around it that are available. There are also questions about the returns. How do we enhance the potential return? Solutions that may be untested, solutions where uncertainty is high. So this is where we think about the types of sectors that were mentioned earlier, whether it's climate, whether it's other transactions. Those require some additional contribution in terms of enhancing the returns. And lastly, the incentives. How do we align incentives on different parts of the transaction to make sure that things come together? And this is where, again, performance incentives and other types of instruments come in. So hopefully this has given you an idea of both the size of the challenge, at least when it comes to the IFC, the different types of instruments that are available, and some of the thinking that, at least on our side, we have been trying to develop around the principles of the use of blended finance. And now I'll hand it back over to our moderator and the distinguished panel. Thank you very much.
Thank you very much. That, of course, was Denis Medvedev. He's the director in charge of economic policy research at the IFC. It certainly does set the stage for what we're about to discuss in just a moment. We've got a fantastic panel lined up for you, and it's a mix of people who are both on the funding side of things, but also on the project side of things. If I may just ask all of them to come up to the stage in one go, I'll introduce them as they come up. We have Sepidi Moramong. She's the COO of Africa 50. It's an interesting fund. She'll explain exactly what they do in a bit more detail once on the panel. Olivier Picard, president of Ellipse Projects, is also on the panel with us. We also have Tony Ofori, Director of the Global Sustainable Finance Group from Bank of America. And we have Claude Guibert, the Director of Structured Finance for Sub-Saharan Africa at Societe Generale. Ladies and gentlemen, this is your panel. A round of applause for them, please. I'd like to start the discussion, if I may, around the question of what risk is. How do we assess risk? Is there a gap between perceived risk and actual risk on the ground? And Olivier, I'd like to start with you because you're essentially actually investing in projects across Africa. You've put money into the ground, you're risking your own capital. What's your assessment of risk?
Yes, it's a very good question. The way we proceed as Ellipse in building turnkey hospitals and healthcare infrastructures is we pre-finance. First of all, we are using our equity, and we are also doing the project finance and export finance. And to evaluate the risk we take, first of all, it's we need to target the best countries in Africa, the less risky ones. This is the first one, so it's a macro analysis. And then we discuss with people, and particularly with the government and ministries of finance, to know exactly if the project is a priority, or if it's not a priority, it's just an idea of a minister. And after that, when we are absolutely convinced that this is a very important objective for a government, we pre-finance all the feasibility studies, the ENS studies. This is very costly, or in case of project finance, we organize everything, the financing, and also we put the equity to make sure that the project will work.
Sepidi, you, as part of your job at Africa 50, to begin with actually, you need to explain that to us. What does Africa 50 do? What is its mandate? How does it fit into this conversation around blended finance?
Great. I wish I could speak a lot louder. Please have a
Oh, sorry.
Hang on.
Thank you.
Thanks for that drama. Good morning, everyone. So Africa 50 came about really to address what we believe is a market failure, right? Which is the need to accelerate infrastructure financing on the continent. But what we do is very different in that we're focused on the equity side of things, right? So a lot of people on the panel here and earlier have been talking mainly around debt financing. What we do is we bring projects to bankability. So from a concept to bankability, where we see the biggest need. In addition, we provide financing later stage, so just before financial close, to providing also growth capital. So what we look at is really end-to-end from an equity and a quasi-equity perspective. And the beauty about this is the funding actually comes from 29 African governments, 2 central banks and the African Development Bank, which is really to say, how is it that we can accelerate infrastructure development on the continent?
And all of this funding, is it coming through in local currency, or is it a mix of local currency and USD, euros?
It's all in USD, right? And so what that points to is the mismatch in many instances, right? Where you can fund a project where the revenues or the income is in local currency. And we've seen what has happened over the past couple of years with the blowout in many instances of our local currencies from an FX perspective, or limited liquidity with regards to FX. So the question is, how is it that we can bring in more local currency funding into our project to minimize that currency risk?
Indeed. Tony, Claude, you're on the banking side of things, so let's pick up on that point that Tshipi is making. Is there appetite on the funding side to actually, take on these risks, to actually invest in infrastructure programs in Africa? And if so, at what price? Tony.
Thank you. I definitely think that the appetite is there to do these projects, but when you're talking about the risk with the FX risk, and it's not just the market risk, if you like, the fact that the FX can depreciate, you've also got currency convertibility as well as the transferability risk as well. So I think, when you're thinking about the suite of risks associated with, FX, interest rates, etc., you are looking for these tools that can help to mitigate that. And once you do find solutions, I think, in that path, it is possible, I think, to kind of put these transactions together. But I mean, I work for a Western bank, Bank of America, and we do struggle, I think, to get comfortable with the local risks. But what I would say is that I do think there's a number of solutions out there.
Give us an example of that. When you say you struggle to get comfortable with local risk, what does that translate to in real terms? If for the sake of argument, if you're trying to build a hospital in Ghana, how would you go through that risk assessment process?
Sure. So, I mean, the team that I work for specifically looks at renewable energy. So, I mean, I can talk about the infrastructure kind of, should we say, approach in general. But, I mean, look, fundamentally, you have to have some kind of commercial cash flow, right? And I think that where we operate in terms of the team that I work for, which is the Global Sustainable Finance team, I mean, we're looking for something that can support, repayment of debt within a certain tenor, which would generally be 10 to 15 years. So the assessment that we're going through is always primarily, where is the cash flow? Where is the commercial cash flow that can actually generate the income for you to be able to pay down your interest and your principal, your debt service? I mean, the underlying project itself, depending on the mitigation tools that you have, you asked me to kind of give an example of that. I mean, there's a fund out there called TCX, which is supported by DFI money, as well as other donors, and that kind of helps to kind of, if you say, take the edge off what happens when you're looking at how to hedge cross-currency risk. But I mean, the underlying projects themselves, I suppose, in some ways, don't necessarily get the opportunity to have the right commercial assessment in terms of the path you need to take from construction to full operation to the ability to service debt, if you're not able to actually solve the currency risk in the first place. But I mean, if you like, the process of assessing the project doesn't differ that much as you go between the continents. It's in terms of fundamentally what you're looking at for the cash flows and the ability of the project to actually sustain its own, to sustain a debt service profile.
Claude?
Yes, we on Surgeon side, we definitely have appetite for infrastructure project in Africa. So in Africa, we are based in 18 countries. And my team covered 13 countries in sub-Saharan Africa. And we have been involved in a lot of projects. What is the key in infrastructure project is that we are facing more and more longer-term maturity. So we have maturity above 10 years most of the time. And this is a bit more and more difficult for banks, local banks, and particularly when we are contemplating financing in local currency. As you probably know, most of the banks has liabilities that are very short-term, as capital markets in Africa are not as well developed or as in Europe. So typically funding is generally very short-term. And we have to fund very long-term projects, 10 years, 15 years, 21 years in some cases, and there's a transformation risk. And to cover that transformation risk, that's where the blended finance is key for us, and the partnership with DFI to cover long-term tenor, to bring additionality through de-risking scheme or risk-sharing agreement. And that's for me, that's blended finance. That's what we can improve. Is the product.
That partnership with DFIs needs a bit of work.
Exactly.
All right, Olivier, I noticed you were nodding quite vigorously when Tony was speaking. Do you want to jump in with your comment?
No, it's. I believe that first of all we need to differentiate the export finance and the project finance. I believe that in the project finance, I do believe that the African DFI can help. I do believe that the local bank can help much more than the French or European banks, because we had this discussion just before the meeting, but I do believe that the European, maybe I'm going to shock people, but the European and probably the American banks are not interested in project finance in Africa because tickets are too small. They are looking for hundreds of millions of dollars or euros of tickets. And the problem today is to finance hundreds or 50 million euros project finance. And I believe that here the African banks, Société Générale, including Société Générale in Africa, can help a lot. But don't ask to Paris, for example, to finance such a project. They will never. They will say no. It's too small for us. But asking African bank, it's possible. So it's a question of ticket. So the African banks are very flexible, more flexible than the European, but tickets are smaller, so it fits for medium projects, not big project, but medium.
If I may answer to that one, what needs to be taken into account as well is the regulatory pressure on European and American banks with capital charge when they are looking at what you were mentioning as highly perceived risk, because we are talking about perceived risk, and there are increased regulatory pressure on capital, which impede the capacity of foreign bank to intervene in Africa, and that's why we are seeing more and more international bank leaving the continent.
This is absolutely true, but I believe that their appreciation is wrong. And this is the way they have invested in Russia, and they haven't invested in Africa.
Sabine.
So I think we're talking about risk, right? And the bottom line is, it's all around how you allocate the risk, There's no project worldwide that doesn't have risk. So the question is, who do you allocate the risk to, and who's most best placed to take on that risk, right? And as the panelists have said earlier, how do you mitigate that risk? So if you think about construction risk, who's best placed to take that in any project? It's going to be an EPC contractor. The financial risk will be the financier. Then we need to look at our governments who need to take on the regulatory risk and ensure that the regulatory framework is in place. So we talk about perceived risk, but I think let's be quite clear that we've done incredible projects on this continent. And the reason they've worked is because we've been able to allocate the risk to the people most best placed to do it.
Give us an example.
Frameworks work beautifully, right? So as Africa 50, we've invested in a 400 megawatt solar PV plant in Egypt called Benban. And the beauty about that is you've got a project sponsor, Scatec, you've got ourselves as a financial investor within the equity, and Norfund as a DFI in the equity. You've got a project that's well thought out. From an Egyptian government perspective, you've got the requisite regulatory framework in place, tariffs that you understand what they are. And with that, you're able to bring in long-term debt financiers. What we've been able to do with that project additionally is several years later, we're able to refinance the DFIs and bring in private sector investors through a green project bond, right? So that's one of the first, it was $345 million of a green project bond that we're able to do. Yes, because of the tenors, right, we also had to bring in partial risk guarantees. These are instruments that we use on a day-to-day basis through, risk, insurance covers, partial risk guarantees that we can use to extend the tenors that we've been talking about earlier, in which cases some of our local banks aren't able to achieve those tenors. So I think it's important for us to be very clear that risks are there, but there are mitigants for it. And the key thing is, how do we find the mitigants for our projects?
And you actually bring me to my next question, because one of the things that we also do need to discuss is, what do the government side of things, what do governments need to do to ensure that investors are given that comfort that we can deal with these perceived risks, that we can stretch out the maturity, the tenors of these particular lending instruments that we're talking about. One of the things that I love about the example you gave with respect to Egypt is we had clarity on revenues. The tariffs were set, you know exactly what you're looking forward to in 5 years, in 10 years, in 20 years. From where you sit at Africa 50, what else needs to be done?
So I think we always talk about an enabling environment, and what does that mean? So if I look at good examples of where large-scale solar, and I'll speak specifically to solar now, have done well, is where there's been capacity at a government perspective, right? So if I look at South Africa, the Renewable Energy IPP program, it was very clear. There was a well-capacitated PPP program that was set out. What's critical for our governments to do is, for us as investors, I need to know what are the priority projects. Olivia mentioned it earlier. What are your priority projects? What does your infrastructure program look like? So that I, as an investor, are very clear as to this is what government X wants to do, right? It's around the regulatory framework. And it's not always around having a PPP framework, but what is it that I can expect as a long-term investor in that market? The other things is really around, we talked earlier about local currency. How is it that we can unlock things like pension fund reform to be able to catalyze capital from institutional investors in the market? So government needs to step away from investing in projects. I think what was spoken about earlier, there are certain low-return social infrastructure projects that government should take responsibility for. But in the main, they really should let the private sector work together with them to execute on projects.
Anyone else want to jump in on that? Sure, go for it. Claude and Olivier.
Yes, indeed. As she rightly said, long-term investors are concerned about regulatory and legal framework to be sure that during the long-term investment, nothing will happen in terms of stability of the country. So this is key. Another key important point that you mentioned is that regulatory bodies should encourage the development of capital markets through enabling, for example, long-term investors such as pension fund, insurance, high net worth individuals to be able to participate in long-term projects through project bonds, for example. This will improve the liquidity and put pressure on prices to be lower for the project.
Tony, you want to comment on this?
Sure. Look, I think, there's an expression I like to bring up in situations like this, which is some audience members may have heard, but it's kind of, don't hate the player, hate the game, right? As in, if you're trying to effect systemic change, you need to work on the pillars of the system. Otherwise, it's very difficult to shift things in the direction that people really want things to go. And so I very much, the expression that Shapidi used, enabling environment. I mean, it's a bit of a cliche term these days in that you hear that's what governments need to create. But I mean, it really does, for me, come back to that basic tenet in that if you don't create a system that allows capital to flow efficiently, if you don't remove the friction costs, if you don't remove the vested interests that allow the right things to happen, it's very difficult for everything else to follow through. It doesn't matter how much money, expertise, technology, intellectual power you throw at a problem. And so when I think through kind of what I think really needs to make sense, or what really makes sense, I mean, I've never worked for a government organization, I've only worked in the private sector, but I do think that the private sector is very much going to be the accelerant that actually shifts from, if you like, the issues that we have at the moment in terms of, further infrastructure that's needed, further kind of environmental, should we say, sustainability policies, etc. But if you don't create the environment for the private sector to thrive, I don't see how you solve these problems with, just DFIs, just governments. And so for me, it always comes back to the question, are you creating the right systemic infrastructure? Not physical infrastructure, systemic, so I'm talking about rule of law, taxation, cross-border investment facilitation. Are you creating the right system for that private sector capital to flow?
Do you think, given the macro context in which we exist in, when COVID hit, about 38 million Africans were pushed back below the poverty line. You're looking at governments that are struggling to cope with gigantic deficits up and down the continent. Tax bases have been significantly eroded. The general thinking now, and I know we can't exactly generalize, go down the whole Africa as a country route, but the general trend that you see now is governments are looking to squeeze as much taxes as they can out of whatever limited tax base they have. Tax predictability is going to be a problem in 2023, probably into 2024. In that sort of environment, is funding going to be constrained?
Of course, I think it will be a constraint, but then I guess to the extent you look at the government coffers as having a fixed pool of money, you can't, without kind of printing money, fiat currency, etc. Looking at a very basic level, if you consider that to be a fixed pool of money, where you're not necessarily printing more money to get out of the problem, where else does the capital come from? And my answer to that question is the private sector. But the private sector are not going to come in without a certain level of, as Shapidi mentioned, risk mitigation, and that's where the DFIs come in. So for me, the whole, if you like, premise of how you solve this problem is that keyword collaboration, right? How do you get the right partners around the table so that people are able to deploy the capital, at the right points at the right time? Government taxation and government funds is not going to help the infrastructure development problem insofar as where I see continental Africa moving, right? So if you're saying that the money can't come from government sectors and philanthropists, etc., pension funds, slightly different question. Where else does it come from? And the one thing we haven't mentioned so far, I think, is the SME sector, right? Small and medium-sized enterprises, right? I think if you look at the splits between kind of big business and SMEs across even the world, in the kind of Western world, but particularly in continental Africa, the splits is something like 70-30 in favor of SMEs, 80-20, SMEs, big business. And so if you're not doing things to help, should we say, that part of the economy thrive, right, then it becomes very difficult to figure out kind of where you really take the conversation next, because people talk about capital, but capital is the first order resource, right? You go from capital into paying people to do jobs. Those jobs then help to build the economy and help to do things like build infrastructure. If you can get the right kind of SME investment process working, the amount of capital you need to build some of these large-scale infrastructure projects isn't as much as you'd think. I mean, trying to get labor, kind of, you see a lot of these projects, actually large-scale projects, you import labor from, Turkey, China, etc., to do projects on the continent. If you can train local people, you pay them local currency to do local jobs, the main number of billions of dollars you need to do these projects suddenly, gets reduced by quite a material sum. So, the way I see it is that, focus on the private sector, focus on the SMEs, go to Olivia's point from before, you are going to create smaller ticket projects, but I mentioned in my opening comments about the tools. There's aggregation tools out there, securitization. You can figure out ways in which you can bucket these kind of financial tools, these structures together to get to a bigger number. But the question is, do you have the right collaborative environment to staple these ideas, concepts, and financial technology together?
Zabidi.
I think you're on point there, Tony. It's around collaboration, right? But one area that we haven't talked about is, with regards to capital, is the asset management pension funds, so institutional investors on the continent. We've got an estimated $2 trillion of assets under management between insurance companies, sovereign wealth funds, and pension funds. What's constraining us is the legislation around some of the investment policies. So the question for us as an institution, as Africa 50, is how do we work with our institutional investors on the continent to unlock that $2 trillion?
I presume, within the limits of NDAs, you've had these conversations with governments and pension funds. So when you walk into a room and say, there are these investment opportunities, we have these projects that are bankable, that are viable, that are ready to go, but your pension funds need to be putting capital into this. What response do you get?
So I think people are understanding what infrastructure is as an asset class. We're seeing a lot more interest. As Africa 50, we're currently in the process of raising a $500 million private equity infrastructure fund, the Infrastructure Acceleration Fund. And the support and the interest that we've seen in that fund has been incredible, and specifically from African institutional investors. So I think I'm really heartened at the fact that people are willing to look at infrastructure and asset class. Obviously, the policy needs to follow. We've got the Africa Financial Forum for Institutional Investors. Oh my goodness, I've just blanked out. But it's really, it combines, it brings together several sovereign wealth funds together under a platform where they're looking to see how they can get involved in infrastructure. So ourselves, together with them and the African Development Bank, have come together and sort of said, how do we work together? One, to get your members closer to infrastructure as an asset class, for them to be able to co-invest alongside or invest in vehicles such as the Infrastructure Acceleration Fund.
This is a bit of a two-part question to you, Olivier, and CPD as well. How do we get all these different players in the funding ecosystem to play together? Because they all have very different incentives. If you're a pension fund manager, for example, your focus is capital preservation. I need to ensure that there's money available. I need to deliver an above inflation return, right, for my clients. If you're a bank, right, if you're Tony, it's a completely different conversation, right? I need to get the best possible return. And if that best possible return is, just parking money in 364-day notes that are yielding 10%, then, if that works, why would I fund anything else? How do we get all those players in the same room working together?
I think there are two ways. If you set up a PPP or a private investment project in Africa, let's say hospitals, because I know hospitals, turnkey hospitals. First of all, DFI can provide part of the debt to help the PPP or to support the private hospital if the private hospital has a social impact or a green impact in a country. So this is for the building of the hospital. But after that, and here I believe that there is this is a need, a very important need in Africa. It's about the training and education. There is, for healthcare infrastructures, there is a lack of doctors, nurses, technical professionals all over the world, but particularly in Africa. And here, DFIs can help a lot in order to promote, to provide, and to help government to get more doctors and these healthcare personnel.
But isn't part of the problem here that DFIs, by their definition, right, they work in a very deliberative manner, right? You've got to have all the I's dotted, the T's crossed. Are you in compliance with this law, not just within Africa, but in the markets in which they're based in? The element of speed is important, right? We've got 600 million people in this continent, for example, who are not connected to grid power. We've got to get them on somehow, and DFIs sometimes just work a bit slowly.
This is absolutely true that today, in terms of pace, and the DFIs are relatively slow, I would say, or very slow. The procedures are. Look, if I can, I'm not mentioned anybody, but in a country like Burkina Faso, we have pre-financed all the studies and everything for one hospital. The hospital will, after 2 years of work, the hospital will sign, finance, and we are going to start the hospitals. And during that time, a DFI has only started its own process. So it took about 3 years for the DFI to start the process after three types of different studies, environmental and so on. So on our side, the way we do business is we prepaid, we pre-finance everything, feasibility, ENS, absolutely everything, and we provide the financing. And this is today the fastest way to meet the requirements of governments. After that, for PPPs and I would say for the environmental part, and in the environmental part there is a maintenance, there is also the training. Here, I do believe that the DFI can play a big role.
I'm going to come to you, Tony, in just a moment, but Sapiti, do you want to weigh in on this topic? Getting everyone around the table and making sure everyone plays nice.
I think everybody plays nice. And one needs to think about a project from a standpoint of the capital structure and the type of capital that's required. So, as Olivier was talking about, within a PPP framework, you've got the equity providers. So institutions such as Africa 50, such as the project developers who need to have skin in the game, who provide the riskiest part of the capital structure, to fund the technical studies, to fund the feasibility studies, to fund the ESIAs. Then you've got the debt providers, right? And those will be the senior debt providers, and we've got the whole gamut, which will be the development finance institutions who can potentially provide the much longer tenors. You've got the local commercial banks who can provide the trade finance aspect of the business, trade finance aspect of it, who can provide the local currency aspect of it. And then in addition to that, you've got the risk mitigators. So the likes of the MEGAs, the AFDB, partial guarantees, Afro-Exim, there are lots of institutions out there that can provide the wrap for the longer term financiers. So I think in all of this, though, it's about bringing people into the process much earlier. So that's what we do as Africa 50, working with government to make sure that we've understood the regulatory framework, making sure that from a capacity perspective, we're supporting the governments from there. Then we're working with the sponsors to unlock whatever obstacles the sponsors might have in the executing of this, to get the project to bankability. Because at bankability, that's when you can then bring in the the DFIs and the commercial banks into the project. But it's at that point there's a whole lot that needs to happen before you get to that point. So it's really around, from a very early stage, bringing along the various players.
And speaking of bringing along various players, if you've got any questions for panel, please start preparing them now. We'll come to you in just a bit. Tony, though, I interrupted. Please go ahead.
Thank you. I mean, look, I'd like to probably comment a little bit about Olivia's point and just this general ethos about DFIs or MDVs moving relatively slowly. Now, I've spent 15 years in financial services myself and I've structured a number of deals, and I would say that there is the headline, should we say, message out there that DFIs do tend to move a bit slowly. But the one thing I'd say is that we talked about collaboration, but the other C word that we haven't necessarily mentioned is compromise, right? And I think that in order for these transactions to work, right? I mean, we had in the materials we sent before this panel, I think 90% of infrastructure projects in Africa fail, right? Or get unreasonably delayed. And if you're going to try and solve those kind of issues, people do need to be a bit more flexible about how you actually bridge some of the gaps that causing these issues to actually occur. And by that, what I mean is that, yes, DFIs have a reputation for moving slowly. Potentially banks, have a reputation of trying to move a bit too quickly. So if banks can be a bit more, patient, DFIs can move a little bit quicker, then you can kind of figure out how to bridge the gap. But I think both sides need to be able to work on that relationship together, right? I'm working on a transaction right now in sub-Saharan Africa. It's a Pan-African solar energy deal whereby we're going across different jurisdictions and the client is supplying renewable solar energy to corporate clients across the continent. We've been told it takes around 6 months to get the partial credit guarantee that we're looking for. But the point is that the client needs it a lot sooner. So instead of just saying, well, the transaction doesn't work, you just have to figure out a mechanism such that you can bridge that 6-month gap that is required in order to get the transaction done. Otherwise, you may not have a solution there. That client may not get to the scale it needs to. So therefore, the solutions across renewable energy, across electrification, as you mentioned, the 600 million not connected to the grid in Africa, the beginning of that problem doesn't start to get solved. And so I just think that it's really, really important to just think about the compromise side about not just bringing the right parties together is very important, but if everyone draws their red line about what they can't do and is not willing to kind of discuss that, it becomes very difficult, I think, to reach a solution whereby you actually start to solve some of the real problems.
Indeed, and I've seen quite a few representatives from risk guarantee funds at this event, so hopefully that's useful feedback for them that we can essentially apply into the market in 2023. I just want to ask a question to both of you, since you're on the banking side of things. Securitization, it's not really taken off in this part of the world. It's not really developed in our capital markets. And yes, there are myriad risks that we need to take into account. But if we were to build a securitization market in this part of the world, perhaps in Joburg, perhaps in Nairobi, perhaps in Lagos, what would we need to do to get that market off the ground?
Yes, well, securitization purely for infrastructure projects, I don't believe we are there yet, because I said earlier, I believe with this market should be more mature, more liquid to be able to create structured products such as securitization and to be able to distribute them to other relevant investors.
I mean, but surely in some countries, we might be there. South Africa, for example, relatively large capital markets, active stock market, active bond market. They might be able to host something of that sort.
Honestly, I'm not very familiar with those markets, but in the market where we intervene in West Africa, in Madagascar, the market are not there yet. But to go back a little, what you were saying earlier that is very important in this blended finance is coordination. Who is coordinating the global actor, as there are many actors involved, DFI, bank, we were talking about institutional investor, high net worth, private, and who's coordinated is key to develop those this type of financing. And I believe that banks has a key role in coordinating the private sector side, alongside, of course, DFI, but banks should be able to, it is our role to take this type of risk. It is not the role of typical institutional investor. That is not their job, if I may say it like that. So if we are able to properly analyze, identify, mitigate the risk, we should be able to share this risk with other relevant investors that has appetite for it.
Tony, and then Olivier. Then we'll go to the floor for questions.
Sure. So just for reference, I spent the first 4 years of my career on a securitization desk. So if we're talking about traditional securitization, where you have a pool of bonds, you put it into a bucket or a special purpose vehicle, and they issue notes into the capital markets, then, I mean, look, I think we've got to learn to walk before we run, right? I think, when you're talking about securitization, you need pipelines of deals, you need liquidity, you need enough deals for the diversification to work, you need the rating agencies on there, so that, when you issue the notes off the back end of the structure, you actually have an investor base that can invest. And so what I'd say is that I think there's a lot more, shall we say, realistic solutions in terms of how to try and channel capital into some of these, infrastructure projects, some of these kind of important projects that need to be financed on the continent without having to go to securitization. I mean, I have looked at securitization in Africa, actually, and it's a lot harder than it looks on paper, right? I mean, the currency risk, for example, and if you're going to do all like dollar, euro bonds, I mean, just trying to figure out how you mitigate that. You can get the DFIs involved to take the first layer of, first loss / equity risk, but I think you start to add additional complicating factors that that start to kind of push the execution risk in the wrong direction. So what I'd say is that I think it's a fantastic idea for the future. I think it's too early, realistically, for the continent, for a lot of the deals that I see on the continent to consider, but definitely something that we should probably look for in the future once we've got a bit more of a developed capital market.
Olivier?
In terms of securitization, first of all, you're right to say that we need to mitigate all risks, but I also believe that the West Africa has an advantage here in terms of currency risk. Second is we are building a debt equity project in Ellipse, and BPI, for example, in France, is ready to ensure the capex of the deal, which is in terms of coverage also a big advantage. Don't know if other countries are doing that, but at least a large part of they ask for 20% of equity and 80% of debt, or 30% equity and 70% of debt, but they are ready to ensure the debt part of the project. So this is also a way to mitigate the risk of a private investment.
Sabine.
I just wanted to touch back on securitization. Yes, not too many securitizations have happened, but there's a very active market in South Africa. As Africa 50, we participated in one of the first multilateral development bank securitizations. This was Room to Run for African Development Bank. $1 billion synthetic securitization, where we worked together with Mariner Investor Group. So we're able to bring in several finances into that. And from a capital structure perspective, we've got African Development Bank, which would take the first loss. As Africa 50, we took the mezzanine tranche of that. And then we're able to bring in the investors for the senior part of it. So the opportunity is definitely there. We're seeing it from an Africa 50 perspective, looking at commercial banks, looking at regional development banks, to try and see, especially now with the need for headroom. How do we create headroom for them to unlock additional capital to reinvest into infrastructure? So how can we securitize some of their infrastructure portfolios? So to me, that just forms parts of the various pools of capital that we can tap into. One of the things we haven't discussed is local capital markets. How do we deepen local capital markets? One, to unlock longer-term, cheaper local currency financing for projects. We're seeing quite a bit of it in South Africa. We're seeing a bit of it in Egypt. But how do we, across the board, really work with our capital markets authorities, and I know we've got a panelist coming later, to make sure that we can get local capital markets involved in infrastructure investment on the continent.
I'd like to open up the floor to questions. I believe there should be a couple of mics roving around. If you have any questions, any comments you'd like to make to the panel, please raise your hand and we'll have a mic coming your way relatively quickly. All right, the gentleman at the back, there's a mic coming your way. Please introduce yourself, give us your name, who you work for, and then give us your comment or question, and please keep it relatively brief.
Thank you. My name is Abubakar Fall. I'm a lawyer, business lawyer from Senegal, and I'm a former legal counsel at the ADF, African Development Bank. My question is related to the issue of risk financing. I mean, how to mobilize local currency for the funding of infrastructure in Africa. And I would like to know, how do you perceive the newly launched PAPSS PAPS from the Afrexim Bank? How do you think that new tool could play a role in the mobilization of funding, I mean, local currency funding for infrastructure in Africa? Thank you.
All right, questions around PAPS, the Pan-African Payment System. Is there any other question from the floor before I take that to the panel? The gentleman on my left, no, on my right, sorry. Please stand and introduce yourself. There should be a mic coming your way in a bit. Okay, got it.
Hi, interesting panel, interesting theme. My name is Jerome Oyiba, president and founder of Lasso Group. It's a financial advisory firm in Gabon, Central Africa. So there are levels to this game. You guys have certainly information that we don't have access to. Tony Ofori mentioned the importance of private sector for the sustainable development of said countries. Government, of course, plays a massive role. But if we take, for example, the US, which I'm particularly familiar with, actually, one of the reasons there is so much liquidity and the capital is flowing is the fact that businesses stepped up and influence politics. I'm talking about the good influence, of course. So, do you think large corporations or big companies have a responsibility to help you guys put more trust into us by influencing regulatory issues, or develop some kind of new financing, let's say, systems over long term or short terms? Thank you.
All right, thank you. Let's start with that first question around PAPS, the Pan-African Payment System. How can it help mobilize local capital? CPD, do you want to weigh in on that?
So I think PAPS is really around making sure that cross-border payments are much more efficient, right? So anything that enhances payment processing is definitely going to enhance financing in whatever form. And I think, to me, the beauty about this is you're getting a Kenyan being able to invest in Cameroon or Togo, right? You're getting a South African institution that can be able to make a payment for a project, for a trade product in another country.
And without having to do that round
without having to do the round tripping of the dollar, right? So very excited about that development and seeing how it's going to drive trade financing across the continent as a whole.
Tony, do you want to jump in on the gentleman from Gabon's question around, what can companies do to actually get, favorable, to drive regulation in a favorable direction? And I know we'll be talking to the Capital Markets Authority chair from Kenya a little later on, but do you want to weigh in?
Sure. Look, thank you for the question. Look, I think it's not that much that's actually required, I think, from big businesses in, within local African countries. I mean, I think, the way I see it, if I kind of take the question back a bit, is that I think there's enough tools available out there to help really do a lot. It's just that there seems to be, certain items clogging up the systems. I mean, this is a panel around kind of blended finance and infrastructure gap. I think the DFIs actually offer quite a comprehensive suite of tools that can actually facilitate a lot more capital flowing into the continent. It's just that, I think to an extent sometimes it's ignorance. A lot of people don't necessarily understand what these tools are, how you actually apply for them, what they're available for. You've got to think about competition of returns as well. I mean, investors are generally looking for the highest return for the capital they've got on a risk-adjusted basis, so they just find other opportunities elsewhere. As far as specifically answering the question, I think one of the big things which can help institutions such as mine, other banks, other big investors, institutional investors, is aggregation. Rama talked about the securitization, should we say, question before. That's along the same area. We need to be able to aggregate smaller investment opportunities into bigger investment opportunities and then be able to invest at the bigger investment opportunity level. And so the one thing I would say is that if large corporates can figure out creative ways in order to aggregate investment opportunities, I think that would have quite a transformative effect in terms of conversations. Whether that translates into deals, one would hope so, but I definitely think there'd be a lot more, there'd be richer dialogue and more penetrative discussions about what, the foreign private sector could do.
All right. Any other questions from the floor? We do have a bit of time before we move on to the next part of the conversation. Any further ones? No. A follow-up from the gentleman from Gabon. Do you still have a mic? No. Okay. So one's coming down to you now.
This one should be very quick. So, except government, in order to assess the risk, there are other public institutions in said countries to know more how to, invest and finance. What is the work that has been done by you guys when you go into these countries, again, except talking to the Ministry of Economy and Finance?
Is that aimed at the banks?
Either. Actually.
Okay.
I'll just answer that quickly. I mean, look, I think, our first introduction into countries generally tends to be at the private sector level, right? So we generally tend to be deal focused. So for example, if we're looking at an infrastructure project, we'll talk to developers, right? And then we kind of leave it to the local expertise to figure out the path to navigate with governments. I mean, when you're talking about big banks, Western banks, we've got to be very careful about the level of interaction we have with governments, whether it's looked at lobbying, all of the sensitive issues about politically exposed people. So in general, we don't have detailed conversations with governments unless it's something like a Ministry of Finance type instrument that we're looking to do, like, for example, a Eurobond.
Maybe if I can just add something, is that everywhere we are involved in financing, we need to make sure that all the relevant studies are made, and if there are local bureaus that are expert in providing those studies, of course we will need to have the local view of the market to be able to assess risk more carefully and more specifically.
Olivier.
Yeah, you have to make the difference between the export finance and project finance. For export finance, we based all our analysis, first of all, on what you say, the local economy and our knowledge of the country. First, second, the macro provided by World Bank, by IMF, by all these international institutions. And we have our own database. But after that, it's a question of sovereign guarantee from the government. So the discussion with Ministry Ministry of Finance is absolutely key. On top of that, you have all these data. Regarding the PPPs and project finance, it's more complicated because you need to have your own business plan. Everything is based on business plan and how you are going to mitigate the risks and how you are going to really find the business, a profitable business in the country. So here the discussion of the government is something important, but this is not the key. The key is really about, first of all, your personal feeling, the feeling of the company, the knowledge of the country, and all the marketing studies you are going to make to build your business plan.
Sipini, do you want to weigh in on any of the questions you've had?
No, I think the last question really on engagement with government, I think the very nature of infrastructure is that you're going to engage with government in one way or the other, right? So for some of us who do sort of large-scale infrastructure, we're working currently with the government of Kenya to put together the first infrastructure, or rather the first transmission line PPP, right? So what does that mean? That means we as Africa 50, together with our partner, the technical partner being Power Grid of India, it's around understanding and working with government and Katrako to say which lines make sense. Where is it that you'd like to evacuate power to? With that means, what are the right-of-ways? So you're also dealing with the Ministry of Lands to understand what those right-of-ways are. You are dealing with government to try and figure out who the off-taker is going to be. Ministry of Finance from a tariff perspective. So you've got multiple players. In any project, you're going to need to get some licensing done. So whoever the licensing institution is, you're going to have to engage with them. And I think in all of this, it's really around talking to them about the benefits of the project, understanding who's going to assume the risk, et cetera, throughout the project lifecycle.
All right. Chipidi Maramong, CEO at Africa 50, I think you've closed that out on a fantastic note. We do need to talk to governments in some detail. Ladies and gentlemen, a round of applause from my panel, please. I'm going to move the conversation on to the next stage. Please welcome to the stage Nick Nesbitt. He is the chair of the Capital Markets Authority over in Kenya and is joining us as chair of our session. Welcome, please. Yeah, that's fine. So, Nick, you've been listening very patiently there for the better part of the last 45 minutes. Infrastructure financing, blended finance, it's a deep topic. We've only covered the top layer of the iceberg here, but what are your initial impressions from that conversation?
Very smart people who really know their business. So I think the challenge that we face in Africa is how do we develop the infrastructure and ensure that it can happen quickly. The countries that developed after the Second World War really took a very strong approach to build it and they will come. They will invest in infrastructure, whether it's roads, pipelines, power generation, and so on and so on. And you can see the effects of it. It has allowed private sector to flourish in Japan, Germany, America, and so on. And the challenge that we have here in Kenya is that it is very difficult for private sector to flourish. The challenge we have in Ghana, Nigeria, Chad, all over Africa, because we do lack a lot of the basics that we were talking about earlier. So the questions that were being asked by yourself and by the panel, or of the panel by the audience, were exactly spot on. How do we ensure that we can find quick ways to drive infrastructure development in Africa?
And, as CMA chair, you're in a unique position because you do see, where the capital is flowing, where portfolio investors allocating capital, what sort of risks are they comfortable with, what are they not comfortable with. And with respect to East Africa, Kenya specifically, we're getting into this rate hiking cycle, the price of credit has really gone through the roof. In 2023 looks to be a very constrained year for raising capital. That's my assessment of it. What's your assessment of capital flows?
Well, you're right. It has been tough over the last few years, coming right off of COVID, going right into these international conflicts. You can see some of the big superpowers, as they're called, flexing their muscles and heading towards Asia. I think we're going into a period economically of a lot of uncertainty. And so with the recent rate hikes of the last few months out of the United States, that's attracting a lot of capital back into the country. And what you've seen there is a lot of people moving to cash, right? So you can see the drops in the valuations of the very largest NASDAQ companies, the New York Stock Exchange companies have been, trillions of dollars have been wiped out from the likes of Amazon and Google and so on. And that's because people are very insecure. And they're very insecure in the so-called developed world, which makes them even more uncertain about the developing world. What that has translated to is those who have the money have moved it to places that they feel safer. And the net result is that we have seen large outflows of capital out of Kenya in particular. I think of the last 2 to 3 years, well over $600 million have moved out of the Nairobi Stock Exchange. A very large percentage of the owners of capital in the Nairobi Stock Exchange are foreign. The interesting statistic there is the largest owners are actually local, but the largest amount of turnover is foreign. So the local shareholders tend to stick in the exchange and the foreigners come in and out. We've seen them move out, right? And we all know the 4 or 5 reasons why this happens. There's the devaluation of the currency, so what was worth $1 million 2 years ago is no longer worth the same in current shillings. You've seen challenges to the interest rates. You've seen the commodity prices going up, energy prices going up. So everything is stacked against us. So when I look over the next year or two, it does not look very optimistic. However, what I am seeing are significant changes in the wind, in particular in Kenya. I won't necessarily comment very much on East Africa right now because my role for the last year has been chairman of the Capital Markets Authority. And just by way of background, for 4 years before that, I was chair of the private sector in Kenya, and I was chair of the East African Business Council, which is a private sector for East Africa. So I had a pan-East African view and did a lot of work during that time to bring the DRC into East Africa, South Sudan, and now we're trying to also move Ethiopia into the region, which will create a very large and strong economic bloc. But the winds of change that I'm seeing are in the new government in Kenya. The president of Kenya, President Ruto, before he was even inaugurated, called us at the capital markets and the Nairobi Stock Exchange to meet him. That did not happen. But 2 to 3 weeks after he was sworn in, he came to the Nairobi Stock Exchange and spent about 3 hours there speaking to private sector and with his soon-to-be installed government officials. And what he was doing was beating the drum of we must use capital markets more effectively to drive wealth creation in Kenya.
That brings me to my next question, because some of the things that we discussed on the panel were around the rules of the road, right? We say we want more people coming into the market, we want more institutional money to come into the market. And I know there's been some work that was done in the past around convincing the local pension funds to sort of relax the rules a little bit and say, you know what, you can invest part of your cash in private equity, you can invest part of your cash in slightly more risky assets. From your perspective as a market regulator, what more needs to be done to get that capital flowing?
There are a lot of things that need to be done. Just by way of background, for many years I ran IBM in Eastern Africa, and we ran a project around the World Bank's Ease of Doing Business ranking, And everything was about what the panel was talking about. I think Tony was mentioning that you just need to make it easier to do business in the country.
Easier
right?
and predictable.
Easier, yes, and more predictable. So what is happening? The president, when he was at this Nairobi Stock Exchange bell ringing ceremony, heard from the head of the National Social Security Fund, who said, if the rules and regulations were corrected, he could have funded our massive railway, the standard gauge railway, which cost $3–4 billion. He could have funded an expressway, a tollway that runs for 25 kilometers through Nairobi. And that got him an appointment at 2:30, 2 days later, at State House. Following that, there has been a lot of work that the Social Security Fund has had to do in delivering very concrete, specific examples to the president that if he were to make these changes, that would enable them to invest more. One of them is allowing more flexibility in terms of how much people's contribution could be to National Social Security. It's around $2, $3.
Because right now, the obligation is, if I invest, NSSF has to essentially put that into safe assets, government bonds, government bills.
Yes. But now, one of the expectations or prayers is that NSSF could put that money into private equity or venture capital funds that are regulated by the Capital Markets Authority. And that will be able to unleash a lot of capital at the lower end. It will also allow sort of mid-cap companies to get additional funding in this sort of public-private mode that we are in. And it will also enable the pension funds to partner with some of the DFIs that we've been talking about here. So that means that the blended finance that the panel was talking about, where you can minimize the risk because you have local capital involved, I think, as Shipedi was mentioning, that will now become possible.
Before I get into my last question, how are you approaching the questions around both innovation and risk? An example that I'd like to give to the audience is around our pioneering program in Kenya to try and get individuals to actually buy bonds through their mobile phones. Emma Kiba, fantastic way of essentially getting, small players into the capital markets in a big way. The tech is there to crowdsource a lot of these funds, pull them together, get them into the capital markets. But, by nature, regulators tend to be a bit more cautious, right? You want to essentially mitigate market risk. So where do you strike the balance between those two? Is it going to be through your sandbox program at the CMA?
Wow, many things in that question. When I was appointed to this role, it was one day after I ended my term as chairman of the private sector, and I got a call from State House. You go take this capital markets job. I said, no, I've done too much nation building for free. Anyway, I lost that argument. But what I was told was, innovate, 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 innovate. Create wealth for people at the bottom of the pyramid, create funding, and allow Kenya to have large companies that can march across borders. What that has meant for me now as a regulator is I have brought to this role an appreciation, being a corporate, and before that, and currently now, an entrepreneur who is looking to raise money. And the most frustrating thing to somebody who is raising money is how long it takes to raise money from VCs, PEs, even angels, how long it takes, especially once you get into the larger ticket items. So what we're pushing for is rapid acceleration of everything. So in capital markets, we're trying to lower the barriers for companies to be listed in the GEMs, which is a smaller market, and lower the barriers for people who are already listed. Now, from the demand side, when you're asking what is it going to take for the public to invest more, before the Nairobi Stock Exchange meeting, we were invited to State House, and it took 3 hours. And we sat with the president, and he used his 2 ears much more than he did his mouth. And he wanted to understand. And what he was saying was, if I am going to invite the public to come in tomorrow, and they come in, and there's a drop in the value of the stock exchange, we'll lose them for a generation. So what he was asking was, can we go out and find instruments, any kind of derivative instruments, any kind of insurance that could protect the smallholder investor from a massive drop. And so that was the homework, and people are coming back and giving him solutions on that. In terms of asset-backed securities that we talked about, I just got a message right now from my CEO of CMA that the president's coming to the stock exchange on December 15th to launch asset-backed securities by the Kenya Roads Board. And there are going to be more after that. This excitement that he has also generated through saying he wants 5 state-owned enterprises listed on the Nairobi Stock Exchange in the next year, including this Roads Board thing, some corporate bonds, all serve to drive interest in the capital markets. The very last IPO, significant IPO in Kenya, was in 2008.
And that was Safaricom. Yeah.
So his question to the people in capital markets and privatization committee and so on is, what on earth have you been doing for all this time, and why are you still earning a salary? So when you ask me about my prospects for the next year, despite the global stuff, the doom and gloom, being an entrepreneur and a business person and as a leader, you always have to be an optimist. So I am optimistic about the conversations that are happening in Kenya, that are spilling over into traditional East Africa, that is spilling over into the new DRC engagement around the investment potential in this region. And this investment potential, like our manufacturing potential and so on, will come from reducing the reliance on foreign investors coming in, as I was saying, who come and go, but investing more in creating opportunities for local investors. And there's a lot of capital that is scared, that is overtaxed, and those taxes are being addressed by the capital markets to attract those investments into the instruments that we provide.
All right. I see our next panel is already essentially lined up, so I'll have to leave it there for the time being.
Oh, you've got a good panel. I saw many of these people yesterday, so
it's a room full of talent.
For all the people who are going to sit here, please stay and listen to this panel, because you've got some good people coming in next.
All right. Nick Nesbitt, Capital Markets Authority Chairman in Kenya. Thank you very much. And of course, thank you, our audience, for your time and your attention.